So you get a raise, your investments are up, your net worth, it just hit a new high. And that feels pretty great, doesn't it? But what if I told you that that feeling, well, it might be a bit of a trick, that the numbers flashing in your bank account don't actually tell the whole story. Okay, let's get right into it, because today we are peeling back the curtain on a really powerful cognitive bias called the money illusion, all to answer one simple but absolutely crucial question. Are you actually getting richer?
To kick things off, let's look at a classic puzzle from behavioral economics. I want you to picture two people. Over here on the left, we have Anne. She gets a 2% raise, which is nice, and inflation is at 0. Then on the right, you've got Barbara. She gets a much bigger 5% raise, but inflation is humming along at 4%. Just take a second. Who do you think is in the better spot here? And that leads to two big questions, right? Who feels happier about their situation, and who is actually truly better off? Now, when researchers ran this very experiment, almost everyone said Barbara was the happier one. I mean, that big 5% number, it just feels more substantial. But here's the twist. Anne is the one who's actually better off. Her purchasing power, what her money can buy, went up by a full 2%. Barbara's, it only went up by 1%. And this gap between how we feel about our money and its real-world power is exactly what we're digging into today.
Yeah, that gap between perception and reality, it's not just some random quirk of human nature. Nope. It's a well-documented cognitive bias that trips up pretty much all of us. And it has a name, the money illusion.
So what is it exactly? Well, to put it simply, the money illusion is our brain's default setting to focus on the nominal value of money. The face value, the number on the paycheck, instead of its real value, which is its actual purchasing power. We get fixated on the number itself, not what that number can really do for us out in the world. And this makes us super vulnerable to these unseen economic forces that can just quietly eat away at our wealth.
So how do we fight back against this? How do we learn to see past the illusion? Well, you need the right set of tools. You need a way to unmask what's really happening with your money.
To see the real picture, we need something like a magnifying glass to look past those big, flashy headline numbers. You see, there's this hidden force, inflation, that's always secretly taking a piece of our money. Understanding how to account for it is what lets us separate the nominal return, that's the number you see on the page, from the real return, which is the actual change in your purchasing power. And that right there is the first step to seeing the truth.
But, and this is a big but, inflation isn't working alone. It's not the only thing chipping away at our wealth. To get the full picture, we have to look at what the source material calls the triple threat. Think of them as 3 unseen thieves of your returns.
All right, let's watch this heist play out in real time. Imagine you have a great year. You make a fantastic 10% nominal return on an investment. Awesome, right? But hold on. First, the government comes along and takes its share. Let's say a 20% capital gains tax. Then your investment manager takes their 1% fee for their troubles. And finally, you have to account for that sneaky 7% inflation that was happening in the background the whole time. You see, every step takes a slice.
So after all that, what are you actually left with? That impressive 10% gain, it gets whittled all the way down to a net real return of less than 1%. 0.93% to be exact. This is such a powerful illustration of how a double-digit gain on paper can become almost nothing in terms of what you can actually buy. This is the money illusion in its most dangerous form.
And here's the part that is just so painful. It's this concept called tax drag. And it's because taxes are calculated on your nominal gain, the paper profit, not your real gain after inflation. So think about it. If your investment grows by 7%, but inflation is also 7%, your real gain is 0. You haven't made any progress. But you still have to pay tax on that 7% paper profit. That guarantees you a loss in real terms. It's a real kick in the teeth.
Now, you might be thinking this is all just a theoretical problem, but it's not. To see how devastating this can be in the real world, let's open up a cold case file on wealth destruction, the stagflation era of the 1970s.
Man, the 1970s were just a perfect storm of economic pain. You had 2 major oil shocks that sent energy prices through the roof, and the whole thing culminated in the Fed chair at the time, Paul Volcker, jacking up interest rates to an unbelievable 20% just to break the back of inflation. It was, to put it mildly, a brutal decade for investors.
And this chart just shows you exactly who won and who lost, in real terms. Now, on paper, the nominal returns for stocks were often positive. But once you adjust for the crazy inflation, the S&P 500 actually lost 2% of its value every single year. Government bonds? Even worse. The only things that actually protected your wealth were hard assets like gold and real estate. This whole period was a harsh lesson that what works in one economy can be an absolute disaster in another.
Okay, so that's the problem and that's the history. But what about right now? How do we take these lessons and apply them to protect our wealth as we head into 2026? The economic landscape has fundamentally changed. Forecasters are seeing inflation settling in at a new normal that's just higher than what we all got used to before the pandemic. The era of near-zero interest rates and easy, almost guaranteed returns, that's over. And this new world requires a much smarter, more defensive strategy.
So how do you build a financial fortress to defend yourself against these new threats? It's not just about how big your net worth number is anymore. It's about having strong walls and a deep moat. This means building a high savings rate to reinforce your walls, keeping your debt low so there are no cracks in the foundation, making sure your own income is growing faster than the enemy, inflation, and having a solid cash reserve as your last line of defense. These are the core principles that make your finances truly secure.
And this quote really sums it all up, doesn't it? This new environment demands discipline. It's all about making selective, high-quality investments and actively managing your risk. It's not a time for just throwing money at the market and hoping for the best. This is a time for thoughtful investors, not for speculators.
Which brings us right back to where we started. The next time you look at your account statement or the next time you celebrate a raise, I want you to just pause for a second and ask this question. Look past that big, satisfying number on the page. Remember to account for inflation, for taxes, and for fees. And then ask yourself with this new clarity, are you actually making money? The answer, well, it might just change your entire financial future.